Welcome everybody to this 36th episode of Corporate Treasury 101. The episode of today is the first of a new series on inflation, interest rates rise, and their impact on treasury activities. If you are evolving in the world of finance, follow the economic news, or simply are looking to take a loan to buy a house, for instance, you may have noticed that interest rates are higher than it used to be in the last years. Also, inflation is going quite up lately, and this for different reasons. This is what we talk about as of today. Before starting this new series of episodes, that we are very happy to serve you, by the way, a couple of announcements. The podcast is now being listened to more than 1,000 times per month. To be honest, we did not expect this after only 4 months of activity on a topic as niche as corporate treasury. Therefore, we really wanted to take the time to thank you very much for listening to this podcast. And we hope it will continue to bring you as much value as we learn and have fun working on it. Thanks to it, we recently had the opportunity to interview two amazing people that we will release the episode with in the coming month, with especially a conversation on Bitcoin in Treasury. Also, we decided to go back, as of next week, to 2 episodes published per week. So stay tuned, and if you are not yet, hit that subscribe button not to miss any episode in the future. We hope you enjoy the episode.
So Guillaume, it's been in the news a lot about interest rates. And I've been hearing a lot about them. We've been talking also in our previous episodes, interest rates has come up quite a lot.
Yes.
So we talked about it in our episodes about short-term funding, short-term investments, financial risk management, also had interest rates because we talked about interest rate financial risk management. I feel like interest rates is a very core topic to corporate treasury, and especially considering banks are the ones that we most associate with interest, right?
Yes.
So what is the impact of this increase in interest rates we're seeing in the economy right now in the world of corporate treasury?
So we agreed on this podcast to talk and focus on corporate treasury topics. And that is a great question you just asked. And before answering it, I will suggest that we take a step back and develop on interest rates because it's a very interesting topic to then better understand their impacts on corporate treasury.
Sounds good. So then tell me, what are interest rates for the people that don't know? I think most people have seen maybe interest rates in their personal bank accounts. They've seen there's an interest rate in their savings account. And perhaps when they borrow money, they know they pay interest rates. But what is an interest rate exactly?
Exactly. So obviously, whoever is lending you money, for instance, Hussam, can't use that very same money for at least the period of the loan, right? So even if you're going to repay what we call the principal, so the initial amount lended, that person will make you pay for it. Because not only that same person can't enjoy the money to buy a car or whatever, but on top of that, he or she can't invest it anywhere else while he or she lends it to you. And the interest rate is a percentage of this principal.
So just to get the wordings right, principal is the base amount you borrow. So assume you lend me 100 euros, the principal is 100 euros.
Exactly.
And then you might want to charge me an interest rate on top of that, right?
That's it.
But you know I'm going to repay you.
Yes.
It's just a matter of time, right? So yeah, you can't invest it, but you're going to get the money back. So interest rate is what the cost to you of lending me that money?
Yes, you nailed it. So, 2 interesting points here. First one, that person or me, indeed, know that you're going to repay, right? You're going to repay me the principal. That's true. But there is always a small risk that you want, right? You can, for instance, lose your job, get hit by a worldwide pandemic, making your business going bankrupt, fall very sick and not be able to work anymore, and so on. Many reasons, right? So my point is, the interest that you're paying are also a reflection not only of the time while you're mobilizing this money, but also how risky it is for the lender to get its initial capital, the principal, back. And as we already talked about it in the short-term funding investment, in the short-term funding and short-term investment episodes, which are episodes 24 and 28 for whoever is listening, the riskier, the higher the interest rate.
Okay, so that's a very positive picture you're painting. So if everything goes badly, you always have the interest rate there to, let's say, cover risk as well as the cost of not having the money
Exactly.
To invest.
Yes.
What about that second part on the risk specifically?
Yes.
Go more into that. What does that mean exactly?
So the point on the risk is I'm lending you money. I'm almost certain I'm going to have my money back, but there is always a small chance that I won't. And for that, I'm going to cover that risk by getting more money in return. That's point A.
So it's more worth it to you to take the risk, because not only are you just going to get the same money back and you're taking a risk, but I'll take the risk if, the reward is also greater.
Exactly.
Okay.
That's it. And the second point is, and you mentioned it, the interest rate is the cost of money over time. And I would also like to touch upon the concept of time value of money, which is a core principle in finance and therefore in treasury. It says that any amount of money is worth more now than that very same amount of money will be in the future, because of what you can do with that money now and because of its earnings potentials. A little bit of jargon here. We also call this the present discounted value.
So that's 100 euros in my pocket right now is more valuable to me than 100 euros in my pocket in a week.
Precisely.
Because in that week, I might have turned that 100 euros into 110 euros.
Exactly.
Right? By, I don't know, investing it somewhere. Maybe I bought some, crypto and made 100 euros into 50 euros.
Yeah, exactly. Or the other way around.
100 euros into 200 euros. Nowadays,
exactly.
So the present value is in the future. If I say, okay, I have 100 euros now, I'm giving it to you. I don't have 100 euros now. I'm going to get it in the future.
Yeah.
So I want back the future value.
Exactly.
As if I had never given you the money. So if we take an example, it's I have 100 euros in my pocket right now. I know if I invest it, I'm likely to get back 110 in a week.
Yeah.
So if I'm lending you my 100 euros, you better give me at least 110. Otherwise, I should just keep the money and invest where I was going to invest.
Exactly.
Is that how it works?
Yeah, that's precisely it.
Okay. So there's also not just the potential of the money you could have made from another investment, but there's also inflation. Right?
Yes.
Is that also accounted in this interest rate? So it's not just the net present value from a opportunity lost, but also things get more expensive over time, right?
So exactly. The impact over interest, we're going to come to it a little bit later on. But what's interesting about what you just mentioned in inflation is that 100 euros now is more valuable than in a week because, I don't know, maybe the prices of anything goes up by 2 or 3% by next week. And therefore, with 100 euros in 1 week, you're able to afford less than you are right now. So this is also to be taken into account. But we're going to come to this a little bit later on. So that's quite a good summary you just drew. Let's keep that notion of inflation in mind. Now, just to finish on what are interest rates, I would also like to approach them with the supply and demand principle. So if money can be seen as a commodity, then like any other product or service, the more there is on the market, the less expensive it is to borrow money. And vice versa. The less there is, the more expensive it gets. And by expensive, I obviously mean the higher the interest rate.
Okay, so that's okay. Because we don't think of money like a product.
Exactly.
Right.
But it is.
Completely, yeah. Because you have money as cash, you have money as a stock is also money, right?
Exactly, precisely.
The sofa that you have has value and is therefore could
Absolutely.
be used as a form of currency. But I want to go, because this episode is intended for people that are really getting into what an interest rate. They've heard about it a lot, but I want to separate out these terms.
Yeah.
So you have interest rates and you have inflation. These are separate things.
Yes.
Because they both start with in, so sometimes you
might be mistook
even
for
I
one
get
another.
confused sometimes. So inflation is over time things get more expensive.
Yes.
Right. So again, it's a big thing in the news right now. The point we're recording this in July 2022.
Yeah.
Inflation, is crazy.
Yes.
Things are getting more and more expensive, largely fuel and stuff like this. So the cost of things is going up.
Yes.
Separately, interest rates are also going up, but that's like set by people. So inflation is the market is doing it, but interest rates people are setting, and we'll get on to why that is in a second. But inflation is costs going up, interest rate is the cost of money itself.
Yes.
So if I give you my 100 euros today,
Mm-hmm.
there's two things I need to take into account. I could have invested that money and made some money back on it.
Yes.
So I need you to pay me for what I could have made.
Mm-hmm.
But also that 100 euros, when you give it back to me in a week, I can buy less things with it.
Exactly.
Because things got more expensive.
Yes.
So these are two considerations that need to be taken into account when I set you my interest rate.
Exactly.
Is that a good summary of it?
That's pretty much a good summary.